This video explains the proposals for fund accounting, included in Section 36 of International Non-Profit Accounting Guidance, as part of the third exposure draft. It also explains changes proposed to Section 5, on the Statement of Income and Expenses, that were originally shared in Exposure Draft 1. Fund accounting is one of the key concepts in INPAG. Having separate funds enables NPOs to track the receipt and use of resources, according to their intended use. It also means that balances on funds carried between financial reporting periods can be shown. Fund accounting is essential for the transparency and accountability for an NPO's funds. All NPOs will have at least one fund. This fund can be known as the general fund, accumulated fund, or general reserve. INPAG uses the term general fund. An NPO may have other funds for a variety of reasons. This could be due to internal operating choices or external public commitments. Maintenance of additional funds may also be necessary because of legal or equivalent requirements arising from arrangements with grantors or donors or local jurisdictional laws. Each NPO needs to determine whether it has funds other than a general fund. INPAG takes a principles-based approach, which looks at the substance of a transaction rather than its legal form. A separate fund will exist in two instances. Either, there is a legal or equivalent requirement to separately track resources and how they have been used. Or, stakeholders have a reasonable expectation that resources will be used for a specific set of activities, and that those resources will be tracked. These stakeholders can be external, such as funders, or internal, such as the governing body. If no separate funds are identified, an NPO will only have a general fund. The reasonable expectations of stakeholders are critical to an NPO in making a judgment about whether a fund needs to be separately identified and presented. Factors that an NPO can consider in assessing whether a stakeholder has a reasonable expectation in relation to an individual grant or donation include the following: the intention by the NPO to act in a particular way, and how that intention has been communicated. Whether the external communication of the NPO's intentions occurs before or after resources have been provided or promised. Any preferences expressed and previous experience of working with that grantor. Past practice. And the level of discretion over the use of the resources. Where an NPO makes an external public commitment about the use of resources raised through a specific fundraising campaign, at the time or before fundraising commences, the campaign must be tracked separately. This is because those responding to the campaign will expect the resources to be used for the specific purpose of the campaign. They would expect that these resources can be separately identified and tracked, to give confidence that the funds are only used for this purpose. The external public commitment creates this reasonable expectation. In some jurisdictions, there may also be a regulatory obligation to separate these funds. If an external public commitment is not made at the time or before the fundraising campaign is launched, a separate fund may not be required. An NPO should track its use of the resources in a fund through regular management reporting. It must in any case keep separate accounting records for the set of activities in each fund. These accounting records will comprise the income, expenses, assets and liabilities. Only the income, expenses, assets and liabilities that relate to the specific purposes of the fund can be recorded for that fund. This can include direct costs, shared costs and support costs, which we will come back to later. Many grant arrangements could be considered to be a fund. To be a separate fund, an NPO must be able to identify the grant-specific assets and liabilities associated with each grant, including non-current assets such as plant and equipment, and work in progress. Payables, receivables and cash associated with each fund should also be tracked. This is because at the end of the grant arrangement, any remaining cash or other assets may need to be returned to the grantor, or may need to be identified as being available for other purposes. For each separate fund, an assessment needs to be carried out at each reporting date. This assessment looks at whether a fund is to be presented as part of funds with restrictions, or part of funds without restrictions. For a fund to be presented as a fund with restrictions, it needs to meet one of two criteria that are set out in INPAG. The first criterion looks at whether the resources in a fund are limited to a specific purpose or activity due to an externally imposed requirement. This will most likely be a legal or equivalent arrangement and can be a formal agreement or a private arrangement. The second criterion is whether an NPO has externally communicated a commitment that the resources raised through a fundraising campaign will be used for a specific purpose. This public commitment must be made at or before the launch of the fundraising campaign. If the campaign has created a reasonable expectation that the resources raised are only to be used for a specific purpose, then the fund is to be treated as a fund with restrictions. It is possible that an NPO has many individual funds that have restrictions. In developing the criteria, a number of factors were considered. The following were not considered to be criteria for deciding whether a fund is to be shown within funds with restrictions. NPOs have a moral and ethical requirement to use all of their resources for their missional purposes. Practically, it might be difficult to separate the moral and ethical requirements relating to the general activities of an NPO from more specific activities. Moral and ethical requirements taken in isolation are not therefore a criterion in determining whether a fund has restrictions. Globally, regulatory requirements can differ significantly. As this could lead to different treatments of similar activities across jurisdictions, regulatory requirements are also not a criterion. The accounting treatment of the resources received into a fund is also not a criterion. This is because the decision about presentation as a fund is independent of the timing of revenue recognition. While these are not criteria for determining whether a fund has restrictions, they may be factors in identifying the need for a separate fund. INPAG Exposure Draft 2 covered the accounting for grant arrangements. This categorized grants as either enforceable grant arrangements, EGAs for short, or other funding arrangements, called OFAs. The obligations in EGAs create a requirement for the NPO to act in a specific way. So where an EGA meets the criteria to be a fund, the expectation is that it will be presented as part of funds with restrictions. This is the case, even though the rights and obligations arising from the EGA may be shown as an asset or liability, rather than giving rise to a fund balance. An OFA can be a separate fund. Limitations imposed by an OFA may mean that fund is a fund with restrictions. Even if an OFA does not create a present obligation for the purposes of recognizing the revenue, it can still be presented as part of funds with restrictions. Later in this video, we will turn to some proposed disclosures, which are intended to provide transparency over the income and expenses in each financial reporting period, and shine a light on situations where there are insufficient resources to fund the required activities, or if there is an excess. The costs recorded against each fund can be the direct shared and support costs relating to the specific purposes of that fund. The allocation of shared costs and support costs should be calculated following the principles in Section 24, Part 2, Classification of Expenses. Costs, including a reasonable allocation of support costs, must be charged, even where they are not eligible to be recovered as part of the grant arrangement. All relevant costs must be charged to the fund, even if there are insufficient resources in the fund at that time, to cover all the expenses. If the costs to complete the specific purpose for which the fund was established go beyond the original resources provided, these also need to be charged to the fund. This provides transparency about the full costs of an activity. The balances on a fund need to be reviewed at the reporting date to determine if any shortfall is temporary or permanent. Where there is a realistic expectation that there will be further income to cover a shortfall, or that there will be additional expenses, the balance will be carried forward. If there is permanent shortfall, this will need to be addressed by the NPO transferring funds from its funds without restrictions. Transfers between funds may be made for several reasons. These include: to make good the shortfall on a fund with restrictions, to transfer a non-current asset that is now held for a general purpose rather than a restricted purpose, where the balance on a fund with restrictions has been released by the grantor and can be used for any purpose, and where the balance on a fund with restrictions can be used for an alternative purpose without legal or regulatory consequences. Critically, a transfer between funds may only be made where this is legally permissible. Transfers between funds in the reporting period must always sum to zero, such that each transfer out of one fund is equal to a transfer into another fund. Funds without restrictions can be used at the discretion of an NPO to further any of its missional purposes. In other words, they are not limited to a specific purpose or activity. Funds without restrictions comprise any fund that has been created through internal designation by an NPO's governance body, as well as any other fund that is not a fund with restrictions. For the avoidance of doubt, the general fund is a fund without restrictions. Where a grantor expresses a non-binding preference on how resources are to be used, this will normally be included as part of funds without restrictions, because it is a preference, not a requirement. Management can track these resources separately if desired. INPAG allows for resources that have been internally designated to be a fund. An internally designated fund can exist, for example, when governing body members set aside resources to be used for a specific set of activities. Such funds must be presented as part of funds without restrictions, because the purpose for the fund can be changed with the approval of the governing body. The internal designation of funds can include setting aside funds for a future project or commitment, such as investment in new equipment, restructuring, or expansion into a new location. This information can be used to explain how the NPO intends to use its funds without restrictions. Information about NPO funds has consistently been raised as a key issue, particularly distinguishing between income and balances that can be used for any missional purpose versus income and balances that have restrictions. INPAG proposes new disclosure requirements. Information is required on each material fund. This information must show the purpose of the fund and the balance at the financial reporting date. Details are also required of the movements on the fund during the year. As a minimum, the total amount of income, expense, other changes and movements between funds must be shown. This information will provide a reconciliation between the opening and closing balance for each fund. The reasons for any transfers between funds with restrictions and funds without restrictions is required. An explanation is required for any balances on a fund with restrictions, where the purpose of the fund has ceased, but the balance has not or cannot be transferred to funds without restrictions. Finally, details are required of the purpose and any planned use of internally designated funds. NPOs need to consider the volume and complexity of information about funds when deciding how to present it to maximize impact. Small funds that are individually immaterial can be aggregated where they have a similar purpose. Disclosures show any shortfalls or excesses on a fund and how these have been addressed. This information is particularly important when shortfalls are met from funds without restrictions. The proposed disclosure note shows how the resources in each fund have been used. It has rows for different funds, grouped according to whether they are restricted or not. And it has columns for opening balance, income, expenses, other changes, transfers between funds, and closing balance. This will help to explain timing differences when resources are received in one financial reporting period and used in a subsequent reporting period. This can lead to surpluses in one year and deficits in others. Disclosures of AGA income and expenses show the obligations that have been met in the reporting period. The provision of information about transfers between funds highlights shortfalls on individual funds and how they have been addressed. This information is important to understand the adequacy of resources for specific funds and operational effectiveness. The proposed disclosures also provide information about funds without restrictions. This can be useful to explain the policy for holding funds without restrictions, or why funds are being set aside in designated funds. Holding adequate funds without restrictions is important to provide a buffer against external factors or events. This is crucial to assessing financial resilience. Specific consideration may be needed for non-current assets if they have been funded through fundraising campaigns, grants, or donations. The terms attached to their acquisition and use need to be considered to determine whether an asset is part of a fund with or without restrictions. For example, if a grant-funded asset may only be used for project-related activities, the asset must be shown in a fund with restrictions. But if the asset, once purchased, can be used freely at the NPO's discretion, then it must be shown in a fund without restrictions. In some cases, a grantor may agree that project assets are released for general use after the project is complete. At this point, the asset will be transferred from a fund with restrictions to a fund without restrictions. The following example illustrates how a non-current asset with restrictions is treated. There are further examples in the INPAG implementation guidance. An NPO is given a grant of $10,000 to purchase a truck. The grant is an enforceable grant agreement, so revenue is recognized as the NPO fulfills its obligations. The grantor requires that the truck is used only on the outreach program, which is due to last for 5 years. Revenue of $10,000 is recognized when the truck is purchased. The truck has an expected life of 10 years and is depreciated on a straight-line basis. The truck is shown in the balance sheet as an asset at its purchase price. In each subsequent year, a depreciation expense of $1,000 is charged, and the carrying amount of the asset is reduced. The grantor's right that the truck is used only on the specific outreach program means that the NPO has decided that the truck is presented as part of funds with restrictions. This is because the truck is not available for general usage. If the truck was purchased in year 0, then in year 1, the fund has an opening balance of $10,000, which is the revenue it received to fund the purchase of the truck. This balance is reduced by $1,000 in each successive year because of the depreciation charge. At the end of the program in year 5, the NPO can use the truck on other activities. At the end of the 5-year period, the asset is transferred out of a fund with restrictions. The balance is transferred from the restricted fund to the general fund. The truck could be grouped with other non-current assets that have restrictions, as part of a single fund for non-current assets, or held on its own. Any decision to group assets needs to take account of external requirements. The development of the fund accounting requirements, which has taken account of the feedback on Exposure Draft 1, has resulted in 2 changes. In Section 2 Concepts and Pervasive Principles, fund accounting remains as a concept, but the detail and definitions are now held in Section 36. AD1 proposed that the statement of income and expenses show different columns for funds with restrictions and funds without restrictions. The disclosure proposals in Section 36 provide this information. To avoid duplication, the statement of income and expenditure no longer requires the multi-column presentation proposed earlier. The requirements for the other primary statements remain unchanged. The statement of changes in net assets will still have columns for funds with restrictions and funds without restrictions. And the statement of financial position will still require a split of the closing fund balance between funds with restrictions and funds without restrictions. This video has been about fund accounting, with the requirement to identify those funds that should be presented as part of funds with restrictions, or funds without restrictions. The term, general reserves, can sometimes be used to refer to the closing balance on the general fund. The term may also be used to refer to the portion of general funds that would be available to sustain the organization in the event of a shock. INPAG does not use the term in either of these ways. INPAG uses the term reserve only in connection with the specific sections of INPAG that require a reserve to be created. For example, there will be a revaluation reserve where an NPO uses the revaluation model for measuring its assets, and it has valuation gains and losses. These reserves are for accounting purposes and are not able to be used for other purposes. Reserves are therefore separate to the funds held by an NPO, and are shown separately to the funds with restrictions and funds without restrictions. In summary, fund accounting exists to track the receipt and use of resources according to their intended purpose. NPOs may have funds in addition to a general fund as a result of choices by management because of jurisdictional law, legal or equivalent requirements arising from grant arrangements, or as a result of reasonable expectations created by the NPO, that resources will be used for a specific purpose. INPAG specifies the circumstances where a separate fund exists, and describes factors to consider, particularly where stakeholders may hold reasonable expectations about the separate tracking of resources. INPAG requires that at each reporting date, funds are assessed to determine whether they are part of funds with or without restrictions. INPAG includes 2 criteria for a fund to be treated as a fund with restrictions. It also sets out which expenses are to be charged to a fund, and when a transfer may take place between funds. New disclosures require that the amounts of income, expenses, transfers and fund balances are shown for each fund, or aggregation of immaterial funds. This presentation provides transparency over any shortfalls or excesses on a fund. An explanation is required for any funds with a negative balance at the reporting date. These disclosures can assist NPOs in explaining the context for any surpluses or deficits in a particular financial reporting period. We look forward to hearing your feedback on these proposals. To respond, visit www.ifrfornpo.org/have-your-say. The invitation to comment includes questions on particular areas where we would like to have feedback, but comments are welcome on any aspects of the proposals. Download a template response document, and upload your completed response or comment letter. Responses must be in English. The deadline is the 16th of September 2024.